Gold was busy this Friday, moving to the upside. So is it safe to say the Fed rate hike has been priced in? Looking at the key technical levels with us today is Gary Wagner, editor of the Gold Forecast. Gary, thanks so much for joining us on Kitco Gold News.
It's great to be here. Great to be here.
Well, it was a big day for gold, to say the least, Gary. Up 2% today. Let's pull up a daily gold chart here. We see the nice bounce this morning, despite the non-farm payrolls, which really was in line with expectations. So what do you make of this rally? Surprised here, Gary?
You know what, I actually am. We've had rallies now for the last 2 days, both yesterday and today. Total move about $30 to the upside. And the fact that we had a jobs report that came out, solid report, 211,000 new jobs added. The fact that a rate hike is absolutely likely in about 2 weeks, and the fact that gold rallied in the way that it did, I found surprising. The other thing I found surprising was when we look at yesterday's activity, it was up $10, but it was really not due to buying. There was selling prevalent in the market, down $11, but the US dollar gave it an extra $22, unlike today, where it's prevalent and predominantly buying.
All right, Gary. Well, before we look at your key levels for gold, we have another interesting chart here looking at gold and the S&P 500. Over the quantitative easing cycles, what trends are you seeing here? Can this give us any clues as to what might happen after this first rate hike?
I really think that it might, and that's why I created the chart and put in QE1, QE2, and QE3. Because what you can see on that chart is when quantitative easing was first implemented, we saw a tandem move in the equities markets in the United States as well as gold. Both of them moved to new territory. Both of them moved to new highs. However, at the initiation of quantitative easing 3, and things were winding down, we saw really a dramatic change in which we saw downside pressure in gold going to new lows, the 5-year lows that we talked about, and new record highs in the S&P, so a negative correlation. What I find most interesting is if you look at where the price of gold was prior to quantitative easing, it was around $800. And that's, to me, the key, because it really means that we could see $1,000 gold. We could actually see it dip a little bit below that as all of this monetary policy begins to wind out of the system.
Well, that's interesting, Gary. So you still think $1,000 gold could be in the cards by year end or next year?
I would say by next year it's possible. Now, it hit a couple of the numbers that we were looking at, and we're currently at a resistance area, which is right around that 80 mark, 1080. Above that's 1103. So anything can happen between now and the end of the year. We're talking about a 3-week period. But I think that by the first quarter of next year, we could see some sort of bottom develop in gold.
All right. And just to wrap, Gary, so a key level you're looking at now heading into next week?
Well, in terms of the resistance side, 1103 is a really important number. 1080 was an important number, but we came up to that. Now, if we have continuation in this rally as we go into next week, look at 1103 as a target that's possibly broken. On the downside, it sees most recent lows at 53, and then again at 61, 1061, 1053. Those are the areas you're going to want to watch and see if there's supportive action if we get selling in the market.
All right, Gary, thanks so much for joining us this week.
Great. And I want to wish all of our Chartthis viewers a great weekend and prosperous investing and trading next week.
All right, Gary, thank you so much. And we'll see you all next week. Thanks for watching.